All right, so you did it.
You bet against me and
Yes,
you lost
I did.
again.
Yes, I did.
Good job.
Well, but I did. I hedged myself.
Yeah? How'd you
like
do that?
every good option trader.
How'd you do that?
Well, I bet against you with Mark, but I bet with you on, Dawn.
Yeah.
So,
did you have the odds working in your favor?
No, I still lost a little money, but I kept the loss small.
Don't bet against Roe.
And if you do, hedge yourself.
All right.
You should always hedge yourself in the market.
So we covered, the diagonal put spread and the diagonal call spread.
Got them both.
We showed the ideal entry points when you want to initiate these positions or when you want to turn a long put or a long call into a diagonal spread, right?
That's what we did.
When you think the stock might be a little bit overbought or maybe it's going to consolidate a little bit before it moves higher, it's a good time for a diagonal call spread. And when a stock has tanked and maybe it just hit a level of support that everybody knows exists.
Or if it's oversold.
Or it's oversold, said differently, that's a good time for the diagonal put spread.
Exactly. And now the thing that we definitely have to remember here is this trade is supposed to be a longer term trade.
Right.
And with a longer time, segment here, we got to remember that it's going to move. Well, things are going to change.
It's a longer term trade, and it's a bunch of short term trades against that long term trade. So you're holding on to that long call for quite some time.
Right.
But then again, what you might do if the call moves deep into the money is lock in some of those profits, right?
Well, we have a combination of strategies here. I mean, what we have here is, when you're looking at that diagonal spread, you have like the covered call,
right,
or covered put, depending on which one we're using to call diagonal or put diagonal.
Right.
But we have to remember there's two options we have to roll here. And people sometimes forget. They're ready, and willing and able to roll that front month short option. But don't forget, we have a stock replacement out month option in the money. That's got to be treated like a stock replacement call or put. If the stock starts moving in our direction, we've got to remember to roll that one too.
Right, so you could basically chop off the bottom half of your diagonal call because you have the long call. Basically what you're going to be doing is you're going to be rolling out that or rolling up the long call, right?
Or rolling down the long put if we're in the case of the put diagonal.
All right, so basically there's going to be some morphing, adjusting your position, some rolling. You're going to be rolling up in the diagonal call and rolling down in the diagonal put spread, right?
And we got a couple other little tricks over here just in case something else happens that we're not expecting.
Ooh. The hairs on the back of my neck are standing up right now. I can't wait to see this.
Are they great too?
Beat it. Go.
I better go do that, huh? You're back, and now you know how to find these longer-term, slow grinding uptrends. And I'll tell you, nobody's better finding these type of trends than Chris, because this is one of Chris's favorite strategies, these diagonal spreads, substituting a long stock replacement style call in for the stock and then selling some premium on it. This is one of the favorite strategies of Chris, the trend rider. So let's talk about the setup now. Here we are. We have found this long-term grinding uptrend or downtrend. What do we do next? Well, the first thing we want to do is we want to buy our stock replacement option. The reason we don't want to sell first is because if you sell first, lighter fluid, baseball bat, your head on fire, wood, hardwood hitting it, you got it. We want to enter through the long way. Why? Because at the very least, if something were to happen in between us putting this spread in or going short, we're safe because we're long an option. And when we're long an option, we can only lose what we spent. We don't have the unlimited risk of the short option out there. So we buy first. We pick an in-the-money, out-month option. You might say, well, Ron, how do I do that? You already know how to do this. This first step is the stock replacement strategy. Think of it that way. Think of it that way. I know you want to do the diagonal spread, but as you step into the diagonal spread to begin with, first think stock replacement. How long do I think this movement will take? I'm looking at 12 months. So let's go out a year and start looking around in the options in that year out option. Okay, now that we're a year out and we're looking at the options, which option are we going to choose? 85 deltas. Let me pick that 85 delta option in a 12-month option. We got it. Boom, it's perfect. Now that we've done that and we've got our long position set, now we go in and start looking at what we're going to sell. We know we're going to sell at the money, and we know we're going to sell front month. That's the textbook. Can we sell slightly out of the money? Definitely. And we're going to do it in a 1-to-1 ratio. For every one of these options I buy in the out month, 85 delta, I've got to sell one front month. Now, while we have the position, don't forget, this is like a covered call strategy or a covered put. The power of it really lies in the compounding, the collecting of that premium month after month after month after month after month. Make sure that you're selling month to month to month to month. And here's the one thing that you might forget about, because you got covered call in your head. While you have covered call in your head, you'd never be thinking about rolling the stock. You don't roll the stock is the stock. However, in stock replacement, and that is kind of part of the diagonal spread, that stock replacement long option, remember, that long option is rollable also. As the stock goes in our direction, we're of course going to be rolling that short month up, right? That short option, we're going to roll that up in the front month. Don't forget to roll your long option and lock in profits from the winnings that you're getting from your delta. So there's two options here. Both need to be rolled. Take a look at a couple setups here. Let's take a look at one that I like, one of my favorite stocks, Schlumberger. We're going to do a long call diagonal in Schlumberger with Schlumberger at $55. We're going to buy 10 Schlumberger Jan 25 leaps. And then we're going to sell 10 Schlumberger SEP 55 calls. We're out in January, a year out, and we're selling the September options, which in this case would be the front month, obviously. And as you can see, they are the at-the-money option. And what are we going to do with this? We're going to roll it. When September expires, we're going to sell October. When October expires, we're going to sell November. When November expires, we're going to sell December. And we're going to keep rolling that out until we get out to where this leap is. Don't forget, the leap can be rolled too. If the stock is trading up and suddenly we see the stock up at 65, 68, don't leave this option here at the 25 strike. Roll it up. Remember, with the stock up at 68, although you've collected premium, you also have some wins in delta from the stock replacement portion. Lock them in. Roll the call up. Here's our long put diagonal and rim. We buy 10 rim deck 100 puts. Then we sell 10 rim SEP 80 puts. What are we going to do? We're going to roll. We're going to roll month to month to month with the stock going sideways. As the stock goes up or down, we're going to adjust our short 80 puts. We might next month be in the 75s. The next month we might be in the 70s. Who knows? But you've got two options here. We know what to do with our short option. Remember that you've got a long option out there. Stock trades down to 70. You don't want to leave these long puts at the 100 strike. Roll them down. You've got two options, a premium collector in the front month that you need to roll, either vertically or horizontally, and you've got a long option that's replacing your stock. Roll that. If the stock goes in your direction, roll it. Now, you can also customize this, and this is one of the things I like to do. Whenever I'm trying to take a long-term position, especially in a beaten down stock, something that's a legitimate company that's not going out of business, but is beaten up for some reason, it's had a couple bad quarters, whatever, I like to try to customize my diagonal spreads. So you can actually adjust your diagonal spread for increased stock accumulation. What I like to do is never jump into this diagonal spread all at once. I divide my total maximum size position that I want to have. I divide it by 3 or 4, which saves me some room for better prices later. I'm actually trying to bottom fish here. The one thing about bottom fishing is, unless you are lucky as all hell, you are probably not going to buy the dead bottom. However, if I don't buy my maximum position on the first shot, I have room to buy more. So if I said to myself, I want to take a position in this stock, it's been beaten up, this is the lowest the stock's been in 8 years, I think it's overbeaten up, the industry is recovering nicely, this thing's lagging a bit, I want to hop in. And I know it's going to take a year, 2 years here. What I'll do is say, what's the biggest size position? What's the size position I want to have? Hey, I want to have 20 contracts at maximum. Well, I divide 20 by 3 or 4. Doesn't matter which one. If you want to have 3 opportunities to buy, fine. If you want to have 4 opportunities to buy, fine. Whatever you want to do. And I just divide the 20 by that. So let's say I want to buy 4. I want to have an opportunity to buy 4 different times. I divide 20 by 4 and I come up with what? 5. My first entrance into this position, I'm going to buy 5. This way, if the stock trades down after I bought going long, I've got 3 more shots at buying at lower prices to average me down. I have room to average down. Averaging down is not bad until people start exceeding their maximum position size. What happens is people say, hey, I want to buy 20. They run out and they buy the 20. Now the stock goes down and they say, oh, I better buy another 20. Whoa, whoa, whoa. You've just exceeded your maximum size. Now if the stock continues down and you're wrong again, you have a chance of losing more money than you were willing to. I don't do that. I determine my maximum size before I make a single trade. And I don't do it all at once. I then divide it by 4. 20 is my maximum size, then I don't buy 20 right off the bat. I divide it by 4, I buy 5 of them. Now I have room to add on 15 more contracts if and when I want to. This way we always save some room for better prices. Does that mean I might not get the maximum size position on that I wanted if the stock just out of nowhere, the day after I put on the first 5 just took off? Yeah, that's a risk I'll run. But I'd rather risk not making money than risk really losing money. That's the way an investor ought to think. So we're selling the out of the money front month option instead of selling the at the money. What happens here is if I sell the at the money, I will collect more premium, but I'm going to be limited in my ability to make money on capital appreciation quicker. If I step out of the money, I'm going to give the stock more room to run, but I'm going to collect less premium. If I feel that, hey, this is more of a capital appreciation style trade, then don't sell the at the money. Sell the out of the money and leave room for the stock to run. You can customize it that way. We can tweak it a bit. That's why I said before, either sell the at the money or something a little out of the money to leave more room for the directional play. This way, by doing it this way, suddenly I'm not first and foremost a premium collector. I'm first and foremost a directional trader. And I'm adding some premium collection on. As opposed to, first and foremost, I'm a premium collector, and I'm actually, throwing some directional bias on. That's how you go ahead and play between the two. Sell the out of the money, directional biased. Sell the at the money, premium collection biased. You can actually customize this. Another thing you can do is you can sell the front month options on a ratio. When I bought 5 with the ability to buy 15 more, I didn't sell 5. I decided to only sell 3. That means 2 of the options that I bought are able to run free, because if I buy 5 and only sell 3, the 3 I sell are only limiting 3 of the options I own. The other 2 are running wild. So if we really want to really press it and really get more aggressive with the capital appreciation or depreciation in the stock on the downside with the put spread, I can move out of the money with my sale, bring in less premium, and I could sell less options. That gives me even more room to make more money if the stock runs in my direction. Now, there's a couple dangers with the diagonal, and I don't really want to call them dangers, but you know what? I want your attention on this, because where the diagonal spread is kind of like the covered call strategy, there's a couple things about the diagonal that are not like the covered call, and they're things that could lead to you losing some money unexpectedly. Nothing scary, nothing crazy, just something that, needs your attention. Danger number one, early exercise. Now, I don't want to get everybody flipping out about early exercise. The fact of the matter is, early exercise is really not a big deal. And I actually have a presentation on early exercise in the website at www.optionsgps.com, where I show you how to determine what's going to be early exercised and whether or not it's really a bad thing. To be quite honest, when I'm short an option and somebody exercises early, I want to give them a kiss. You want to know why? Because they have just given up whatever extrinsic value remains in that option ahead of time, and they gave it up to me, the person who shorted. And I thank you very much for not knowing what you're doing. Appreciate it. My children are in college because of you. Now, there's a symptom here. What we have is we're assigned on our short call or our short put before expiration, forcing you into a short stock position, or in the case of a put, a long stock position. Suddenly, you have a stock position that you may or may not be able to afford. Can't tell you how many times people sit there and have this happen to them. The early exercise isn't the problem. What the problem is they didn't have enough cash in their account to either be short the stock when the call's exercised or be long the stock when the short put's exercised on them. When they get assigned that call, they've got to sell the stock. When they get assigned on the put, they've got to buy the stock. You have to have the cash in your account to do it. If you don't, you've got a little problem. One of the things you can't let your broker do to you, and thank God I know Thinkorswim doesn't do this stupid crap, but your broker unknowingly, unsuspectingly, because he doesn't know what he's doing, might then make you exercise your out-month option. Don't let him do it. It's wrong. You have ways around this. You could simply settle your stock position the next day and then resell your short option. It is that easy to get out of. Now, what's the remedy? The remedy is number one, don't let the option get close enough to potential exercise that some idiot decides to exercise, leaving you in a stock position you can't afford. Remember, we had already said that once most of the extrinsic value is gone, don't wait for the extra 20 or 30 cents. You collected $1.50. You want to wait for the extra 20 or 30 cents. Forget the extra 20 or 30 cents. Buy that option back and sell something with more extrinsic value. In this case, we're talking about options that are already in the money. If it's already in the money, buy it back and sell something that has more extrinsic value. Get back to that at-the-money strike. If we keep that thought in mind, we will probably avoid ever being in an option that someone might exercise early. Also, sell an option that's a little more out of the money than in the money. Remember, the at-the-money option is sometimes a little bit in the money. Sometimes it's a little bit out of the money. If you find that your at-the-money option is actually a bit in the money, sell the out-of-the-money option. Go to the next strike. This way, what you do is you're not selling an option that's already in the money with a higher chance of staying there. Go to the the upper strike option and get away from that at-the-money option that's a little in the money. Stick with the at-the-money option that's a little out of the money or the out-of-the-money option. The other thing, Choose a broker who understands what the heck you're trying to do here. Too many of you are going to run into this problem. You're going to be with the wrong broker, and the broker is not going to understand options. I've had many students that have to not only teach their broker, but their broker's manager, then the manager of the help desk. It's ridiculous. Brokers aren't trained in option theory. Don't go to them for help. They don't know what the heck they're doing. Make sure that you choose a broker, if you're going to be trading options, that specializes in options. That's what you have to do to get somebody that's going to know more than you, is to find somebody who's been doing it for a long time. I don't care, oh, your broker says, oh, I've been trading. Shut up. No, he hasn't. He's been putting in orders from somebody else who's calling the shots. Brokers are salesmen. They're gophers. Hey, broker, go get me some IBM. You're the boss. They're the gopher. You're the decision maker. They're the gopher. Keep that in mind. That's all they are. You need to find a broker that truly understands and is an expert in options. Find a brokerage firm that has real option market makers, floor traders that understand this stuff, and use them. Now, danger number 2. Your long delta spread becomes a short delta spread. Or, if we're doing the put side of things, it'd be a short delta spread becomes a long delta spread. How's this possible? Here I am long a diagonal call spread. The stock is going up, but suddenly I start noticing I'm losing money. How is that possible? How can the stock go up like it's supposed to? I had been making money for a while, and now it stops making money. It's actually starting to lose money. How's that possible? Gamma, that's how it's possible. Gamma is your culprit here. See, remember, your front month option has a high gamma. It means its delta moves a lot more rapidly and aggressively with the movement of the stock. So you've got this long out month option, and you've got this short front month option. As the stock moves, the delta of your long out month option isn't going to move much. We know the gamma is very low out there. It's, first off, it's an in-the-money option, which we know has a lower gamma than the at-the-money option. And on top of that, it's in an out month where we know gamma is really low. So you have a long option that's delta is going to remain kind of constant. But it's that front month option, that short option, which has a ton of gamma. And as we're getting closer and closer to expiration, as the stock starts to run up, it's that short option that starts gaining and losing deltas incredibly quickly. And as the stock moves, it could move enough to take your short option and put it at a spot where there's more short deltas now in your front month option than there are long deltas in your out month option. This trade can actually go short delta on you if the stock moves enough. So what are we going to do? How can we stop this? Especially when we're out in a leap where we have next to no gamma. How are we going to do this, this trade where all of a sudden I'm in a long delta position and now it's short delta? What we have to do is understand the nature of gamma and make sure that we roll that short option. Don't let it get that far in the money. Roll it. If it's that far in the money, that close to expiration, there's no extrinsic value anyway. Roll it. You can go a little deeper with your out month option. Remember, you've got a lot of time with that thing. If you are in a strike that you're comfortable with, maybe go one more strike deeper just to give you enough delta to offset this a little longer, to give you more reaction time. The easiest thing to do is to make sure you stay at the money or slightly out of the money in that front month option. If that option becomes in the money, close to expiration, you've got to be quick to pull the trigger. Buy it back. There's not much left in it, extrinsic value-wise, and roll it to the next month out or the next strike up, if that's the case, and collect more extrinsic value. Don't be stuck in that option, that short option that's now in the money very close to expiration, because now you're going to have a negative delta, and the stock is going to be going up like you expected it to, but you're losing money. So we want to roll as soon as that extrinsic value is gone. There's no reason to hold that option once the extrinsic value is gone on the short side. It's just not worth it. And this situation becomes a little more regular for those people that are being diligent and rolling their out-month option. If you're rolling your out-month option up, you're decreasing the delta of that out-month option, meaning it's possibly more likely that you're going to have this danger number 2 hit you. How do we go ahead and avoid it? Don't sit in that short option that's now in the money near expiration. Roll the thing. If you have to roll it a little more quickly than you wanted to, fine. Roll it. Get yourself back in that at the money that has heavy extrinsic value and not so much intrinsic value and not so much heavy short delta. What are my keys to success here? Well, number 1, solid technical and fundamental analysis. I mean, that's a given. That's the way it's always got to be. We've got to find a longer-term trend. This strategy doesn't really work as well with a month or two. To be quite honest, you'll never catch me doing this in something that I think's a month or too long. Why? Because I'll go vertical. I'll go with the vertical spread instead. Front 2 months, I'm doing verticals. Out months, I'm doing diagonals. Longer term trend, diagonal. Shorter term trend, vertical. So we have to make sure we find a longer term trend. We must make sure that we sell the front month at the money options month after month after month consistently. Got to be diligent with it. We want to buy back our short option when most of the extrinsic value is gone. Okay, say if by chance the stock dropped down $5 this month and it's 2 days before expiration and you're looking at an option that's $5 out of the money, there's 20 cents left in it. Okay, you want to get your last 20 cents with 2 days left? Go ahead. Can't blame you there. But if we're close to the at the money strike, or maybe even if we're a little bit in the money, roll that thing. Don't wait till the last second. It's not worth it. And don't forget, there's 2 options here that need to be rolled. You've got a front month short option and an out month long option. Roll both of them as you see fit and as they need to be rolled. And now that we've put on our position, it's time to start actually managing it and adjusting for whatever might happen. Let's take a look at what happens if the stock goes up, and we're going to be first starting off in our diagonal call spread and see what type of morphs and rolls we have. Well, if the stock starts to trade up and we're in the diagonal call spread, obviously we're where we want to be. Now, we could always roll vertically. That happens every once in a while. If the stock moves fast enough from one strike to another, we can always close out our short strike, and if there's enough time still in the month, we could always sell the next strike up and collect premium for a second time that month. Every once in a while, the stock moves enough to allow you the ability to collect a second premium in the month, which is always a good thing. If the stock is going up and we start running out of time with that short option and we come to expiration, we can always roll that short option out at expiration. If the stock is going up but starts to break out, now remember, these rolls are if the stock is trading in its trend. If it breaks out of the trend, we know that in the diagonal spread, we are in a limited position here. We don't have the ability to make big money out of it because that short option is limiting our profitability. Now, what happens here is if the stock really starts to take off and we break out, we can always morph, turning our position into a stock replacement call. So that'll be a long stock replacement position. Let's take a look at what we can do here. First thing we're going to look at is what happens if the stock is trading up and it's in the trend and the stock has moved from the 65 strike, which was the at the money, up toward the 70 strike. Now, obviously, the 65 is going to be in the money. We don't want to stay short that one too long because that option right there that was short, somebody else is long. They might decide to exercise it, and then we have that whole issue of, okay, now we have to make sure our broker knows what they're doing, blah, blah, blah. We can avoid that by simply buying back the June 65s and selling the June 70s. If there's, say, 2 weeks still left in the month, we might have the ability to roll up to the June 70s and collect another round of premium, like so. So what we're going to do is, as the stock trades up, we can follow vertically in the same month, collect a second premium if by chance there's enough time. Now, if there's more time, and this is very rare that you're going to have a stock and a trend that allows you to roll twice in a month, but you can follow for as long as you want, as long as there's enough time and enough premium in that front month at the money option to justify the roll. Remember, if there's 3 days left and there's very little premium here, that doesn't justify rolling it. We're going to be better off rolling out, and we can always do that. But here's the thing. Remember, we've got another option over here. This is like the covered call, except for the fact that we not only have this short option we have to roll, but we've got a long option over here that needs to roll. Remember, this is a stock replacement option. You have to treat it like one. Even though the overall position is a diagonal spread, we've got to remember that this option here is a stock replacement option, and it needs to be rolled too. We can always roll out. If we need more time, if the position is working for us, we come to expiration, it's time to roll out, roll out. If this is working, let's continue it. Remember, rolls are continuation strategies. We are in a position that's working, it's working well, we collected our premium, we're near expiration, maybe even expiration day, roll. Now, if the stock breaks out, what we're simply going to do is we're going to turn our little diagonal call spread into a stock replacement call. We have what we want here. It's just a matter of loosening it up. So here we are. The stock's been trading in a trend. We've rolled vertically. We've maybe rolled horizontally. But now the stock has broken out of its trend. It has violated its upside trend line, the resistance, and now it's off to the races in what we would determine to be a technical breakout. The problem with the diagonal spread right here is this option right here is limiting my ability to make money on the breakout. So what do? I buy it back. Just buy it back. And now what do we have? Obviously not the optimal option to play a breakout, but a heck of a lot better than being limited by that short front month option. So now that we've got that January 55 out month deep in the money option uncovered, because it was covered over here, now it's uncovered, what do? Trade it like a breakout of any other nature. If we have a breakout, we know we want to be in stock replacement. Treat it like that. Roll it. Roll it up and follow. Once the stock stops, then we can reinitiate our short front month option and be back in our diagonal spread. So follow it as far as it goes. Then when it stops, we reinitiate the diagonal spread. Well, what if the stock goes down? Obviously, our diagonal spread is not the position we want to be in. At least we don't want to be in a diagonal call spread. If this was the put spread, it would be a different story, and we'll talk about that in a minute. But the fact is, this is the diagonal call spread, and now the stock is going down against us. Now, there's two types of down that we have to talk about. The first down is it's still in the trend, it's just fluctuating a bit down. We can potentially roll down. However, if it's actually a breakdown where it's broken the trend and we're no longer in this trend that we've been trading, we're going to have to morph the position because we don't want to be in a diagonal call spread if the stock breaks support and starts really gapping down. We'll go ahead and morph into a synthetic put. And remember, if the thing's going against you and you're not sure, you're not comfortable, you can always just close it out and take a deep breath, sit back, reevaluate, and then reinitiate if you need to. So let's take a look at that first movement. Now here we're in the call spread. Just because the stock is going down doesn't mean it's not still in an uptrend. If you've taken a look at any uptrend that Chris has shown you, you'll have seen that there's days where the stock is down but still in its uptrend. If we're talking about that situation, here's our move. We're going to actually roll down. We can do that. provided we are still in the uptrend and we just simply have a down move in the uptrend. Now, if it turns out that this is not a downward move in the uptrend and it's actually a breakdown, then we're in the wrong position. Now we got to talk about morphing it. All we need to do is go to the strike of our short call and buy its corresponding put. What have we done? We have set up a synthetic short stock position. Short the call, long the put, same month and strike. That is short stock. Short stock here, long call here, short stock, long call. That's a synthetic long put, and we're now playing the breakdown. So we've got a very easy morph here. Real quick and easy, turning our diagonal call spread into a long synthetic put. What if the stock stays still? Well, you know what? If the stock stays still, that's fine with us. We are in a premium collection position, and we don't mind if the stock stays still. That's one of the beauties of the diagonal spread, the ability to make money if the stock goes up or if it stays still. If it stays still, there's really no reason for us to change the position. The only real thing we have to do here is to roll. Roll month to month. Keep collecting the premium. As long as the stock stays still, let's just keep collecting premium. Roll that call out month to month to month. Take it right up into expiration. Remember, whenever you're collecting premium and you're short a front month option, the longer you can stay and keep that thing in the game, as long as you can stay short right into the last minutes of expiration, the more money you make. Now, let's talk about the put spread. Let's pretend we now have a diagonal put spread. You're going to notice that these morphs will be just the same, but the opposite of your diagonal call spread. If the stock goes down and you're long the diagonal put spread, you're in the right position. So what do we have? Well, if the stock is moving down, we could roll down vertically if there's enough time in the month to collect another premium, only if the amount of premium is viable. We don't want to be rolling down just for the heck of rolling down. If there's no more premium there, then we've got to roll out. And if the down movement goes from trending to breakdown, we want to be able to free up that long put we're going to have by getting rid of our short put and turning it into a short stock replacement strategy. Now, what happens if the stock actually starts to break down? We're in our trend, the stock is trading down, and suddenly we wind up coming down to support and breaking support. The stock is now in a technical breakdown. That's great. There's only one problem. This is a limited profit position. Why? Because we're limited by this short put. This short put is covering our long put. What do we need to do? We need to get rid of this short put. So what do? Buy it back. Buy that short put back, free up our long put. Now what are we in? Now we are in a stock replacement strategy. This is a short stock replacement strategy. And we're in stock replacement. Stock is breaking down. What do? We roll down with it. Very simple. Roll down with it. Once we're done rolling down with it, we could always reestablish a short put in the front month, returning us back into our diagonal put spread. Now, what if the stock goes up? Well, obviously, we're not in the position we want to be in. However, the stock could trade up and still be in a downtrend. As long as we're still in the downtrend, we do have a potential roll here. We can actually roll up even though we're still in the downtrending position. The stocks fluctuate. Just because a stock is in a downtrend doesn't mean it trades down every day, all day, every tick being down. You're going to have your up days, you're going to have your down days, but as long as you're still in the downtrend, we can roll up. Where it becomes a problem is if we break the uptrend and go into breakout. Here we roll up. We're still in downtrend. It's just that we're in a situation where the stock is trading up, but still in the downtrend. That's different than if we break the downtrend. If we break the downtrend, then we need to do something. We need to change this position. If the stock is now trading up and has broken the downtrend, then we can't be in our diagonal put spread. What are we going to do? We're going to morph it. We're going to morph it. What happens there? When we morph it, we're going to go to the strike of our short put, and we're going to buy the corresponding call. And when we buy that corresponding call, we have now created a synthetic long stock position here in our June 65 strike. Long synthetic stock, long put, that is now a long call. So we've turned our diagonal put spread into a synthetic long call to play the upside. That would actually be the protective put strategy. Long stock, long put. Synthetically a long call, protective put strategy. We're now playing the upside. What if the stock stays still? Well, like we talked about with the call diagonal, stock staying still is not a bad thing. It's a good thing. We're in position to take advantage of that. We've got premium collection, don't we? If the stock stays still, then let's just stay with the position. Continue it. When I talk about continuation, you got to be thinking rolling. Leave the position alone and just roll that short put month to month and keep collecting your premiums. So that's about it with the diagonal spread. Now, obviously, the diagonal spread is a very powerful spread. It gives us the ability to make money in direction, and it gives us the ability to collect premium. Now, all you stock traders out there that are thinking about doing covered calls, stop thinking about doing covered calls. Replace your stock and do the diagonal call spread. It's like a covered call strategy on steroids.
Ron, that was an excellent job on the diagonal calls and puts. I think everybody has a pretty good understanding of it now. I know I have a better understanding of it. Next thing we're going to cover are the straddles. And the straddles are a way to take advantage of when a stock breaks out or breaks down. And I'll show you a couple of chart patterns that show you when that's just about to happen or when it's likely about to happen. But before we get into that, go to the community at optionsgps.com. Talk to your peers about what you just learned. They just learned the same thing. Pass the quiz and then pop in the next DVD. We're going to talk about straddles next.
Okay, what we have here is a diagonal call spread, and what we did was we took the opportunity that Chris found, which was right in here in the NYSE, which is the New York Stock Exchange, the Euronet, and what are we going to do? We are looking for a slow grinding upward pattern, and that's what Chris found here, and he showed you how to do it, so there's no excuse for you not being able to find a slow grinding uptrend, and that's a perfect opportunity to use a diagonal call spread. Remember, if we think that we were in a position to use the covered call, then skip the covered call and go with the diagonal. We've already been through all the different advantages, the cost efficiency, the safety. It's less risky, right? Because we're using the call instead of the stock. We know that we can roll to lock in profits and maintain our same size position. We know that we get a better percentage return. So with all that, we definitely want to substitute our call in for the stock. Now, when we do this, all you have to think of is stock replacement strategy. I know that we've got another leg of this diagonal spread, but for the first step, we have to choose the option we're going to buy, the option that's going to replace the stock. Stock trading at 2150 here. We are looking for a longer term movement. Try to time the length of the movement that you're expecting with your days to expiration. I'm just going to use here the January 2011 leaps. And which leaps do we want to be looking at? The calls, right? We're replacing long stock. When we replace long stock, we want to look at the calls. So what do I see? Well, the first thing I want to do is start looking at the deltas. Start looking at my deltas. We're looking for an option that's around 80, 85 deltas. And what do we find? Right here, the January 12.5 strike. What do we have? $10 option, but more importantly, 80 deltas. 80 deltas. And very little extrinsic value. Remember, with stock replacement, we want to escape that heavy extrinsic value. This option does exactly that. So we found our long option, our January 2011 12.5 strike. And that option we're going to buy. The one thing that we need to do is we must make sure we buy going in first. If you're not going to do the whole thing as a spread, and you can do that in many platforms like Thinkorswim's here, you could put the whole thing in as a spread. Everything goes in at the same time. That's fine. But if you're going to do an individual component, legging into it, the first leg on the way in, when you have two options, one long, one short, is always the long side. We have to make sure that we are never in a position in the markets we are naked short an option. Unacceptable. So we do the long side first. We buy our Jan 12.5 2011 calls. Our next step is the premium collection step. What we have to do now is select the option that we're going to sell. And in this case, like all cases, when we are dealing with premium collection, we're looking front month, we're looking at the money, or slightly out of the money. So here we are in May. We're looking at the June options, close enough. And what we're going to do is we're going to first look at where the stock is currently. Stock is trading at 23.81. With the stock at 23.81, our 24 and 25 calls are both slightly out of the money. Let's take a look at the 25s for argument's sake, figuring that the 24s are directly at the money. Maybe I want to give the stock a little room. If I believe that the stock has a real good chance of moving up a little faster, then I want to move to the out of the money option. If I believe the stock is more in a sideways pattern right now, then I'd probably lean toward more of the at the money for more premium collection. So, depending on my opinion, is the stock sideways or is the stock up right now? I'll go with either selling the June 24 for $1.78 or the June 25 for $1.34. The difference between the two is $1. That means I'm giving the stock one more dollar of movement for capital appreciation to benefit my January long option. So if I sell my January 25s here, because I believe in the stock and I believe that we're in the midst of an upward movement, I'm going to bring in a $1.34 premium against my option, which was a $10 option. $1.34 times 12 on a $10 option is a pretty doggone good return. We can't be guaranteed we're going to get this type of premium every time, but that is what we are shooting for. Again, the more bullish I feel, the further out of the money I go. But again, don't go too far out of the money no matter how bullish you are, because there's no sense in selling an option and collecting premium if there's no premium in it to begin with. So we want to make sure that we're still collecting a decent amount of premium. That's going to be up to you. What do you feel you need as a percentage return if the stock didn't move for a year? Think of it that way. So, very simple setup. Now that the stock starts moving up, remember, we have two options to roll. We know about our short option. Once that's pretty much void of extrinsic value, or at least the majority of extrinsic value is gone, no sense in waiting for those extra pennies. Let's start to roll now. Don't wait. There's no reason to. You're taking on risk by being short this option. If you're taking on unlimited potential risk by selling an option, you better get paid for it. So if you collect the majority, 80% of your extrinsic value in the first 2 weeks, don't wait the other 2 weeks to collect the other 20%. It's not smart. Find another option with more extrinsic value. Roll to that one then. We don't have to have the absolute last penny here. We're collecting premium, and we are still in a bullish position. So we've got that roll. Remember, you're also in a stock replacement position. We have a second option here, the long option. Treat it like a stock replacement option. Stock goes our way, roll it in the exact same way you would if it was by itself alone a stock replacement option. So that's the diagonal call spread using Chris's view on opportunity. Remember, we first find the opportunity. Chris is going to show you that. After we find the opportunity, then we apply the optimal option strategy. Okay, our next strategy here, as we remembered, was the diagonal put spread. That's what we're playing with right now. And what we're looking for in a diagonal put spread is a slow grinding downtrend. And we said it's going to be very much like the covered put, except instead of using the stock, we are going to substitute in stock replacement, form, we are going to substitute a long put in for our short stock position. Now, we already know all the advantages of that, the cost efficiency, the safety, the return, the ability to roll. We've gone through those 100 times. So what we have to do first is we have to find our stock replacement option. Now, although it's a diagonal put spread, we still have to treat that stock replacement option that we're going to use as a stock replacement option. So we were going to do the same thing that we always do when we're looking for a stock replacement put. That is, we're going to go out to the month in question, and we're going to say to ourselves, okay, we're going to go out to January 2011. This is a long-term position. We're going to sell premium on it, just like the covered put. And what are we going to do? We're going to look for our sweet spot, that 80-85 delta option. And it just so happens that in this case, with the stock trading at 48.37, we have the January 2011 65 puts. They're 86 delta, right where we want them to be. They're 1940 bid, offered at 1990. We're going to buy one of those for $19.90. That is going to give us an advantage to shorting the stock at 48.37. A lot safer here, and obviously it's going to provide us with a better return. Couple things you have to remember is while we're in this position, this stock replacement put must be traded like a stock replacement option. If the stock starts to trade down, which is what we want, we've got to remember to roll this put down to lock in profits. Another thing we need to remember is that we want to pick a month that we feel will be in the same amount of time frame as the movement we're expecting. If we are planning on holding this position for 2 years, pick a 2-year option. If you're planning on holding it for 9 months, pick a 9-month option. But try to gauge and equalize the amount of time that you think the movement's going to take with the days to expiration that you're going to pick. So that's our first thing. We also, this is our long option. If we're going to leg in, this is the side we have to do first. We always do the buy side first. We can't do the sell side first, because if we do the sell side first, that means that we have a position in the market that's a naked short position, an unhedged short option. That's a no-no. We always enter into the long option first. Okay, our next move now is to sell our front month option. Here we are at April 21st. That's probably expiration day of April, so our front month option is going to be May. It's going to be the only one with any extrinsic value in it. But it is going to be our front month option, and we are going to look at the money. With the stock at 43.73, we're probably going to look at the 42.5 puts. They're perfect. Slightly out of the money, all extrinsic value. They've got a decent premium attached to them. $1.45 on the bid is where we can sell them. Now that we've established the long in January, we can now establish our short in May. This is our premium collection option. Front month, at the money, or slightly out. We also know that we've got to roll this option too. If this option loses the majority of its extrinsic value, we don't want to sit there looking at it. There's never a reason to sell an option if you're not getting paid properly for it. Having a short option only worth 20 or 30 cents is not proper payment for the risk you're taking in selling an option. We've got to remember to roll. If the stock moves down a little quicker, then let's roll down to the next strike a little earlier. There's nothing wrong with rolling down in the same month. We get to collect 2 premiums in a month. That's a good thing. There's also nothing wrong with rolling out. If the stock is hanging in the area that it is now, we just roll out to the next month once this front month option has lost the majority of its extrinsic value. Remember, don't sit there and collect $1.40 and wait in 2 weeks and wait 2 weeks for the additional 5 cents. It's definitely not worth it. It's a greedy move, and it could wind up costing you big. So once that front month at the money or slightly out of the money option has given up most of its extrinsic value, you see that option trading for 40 cents, buy it back, don't be greedy, sell something new that's got more extrinsic value, and make sure that you get paid for being short your option.